Alright, I'm gonna light up a pipe. I got my, what kind of pipe is this? I got this pipe off of, eBay. Used pipe. I don't give a fuck. It's got somebody else's teeth marks on it. That gives it character. LA Strata is what it says. But I like the design. I always wanted one of these, I don't know what you call them, Apple or something pipes. It's a LA Strata, whatever. I like the pipe. And I got a little haunted bookshop in here. And want to talk about the economy, the Fed, inflation, the stock market. Been thinking a lot today of where I think this is going. So maybe I can take my my knowledge of history and my knowledge of my little bit of knowledge. I've been digging deep into economics and finance, and maybe I can add something to the conversation here. And definitely I want to make a prediction just so I have a record. In the future. But I want to start with this, not this one here, but let's start with this. I just saw this. I heard about it. I believe I looked at it before, but this is very important. This is a very important chart. Okay? I guess the website is called Shadow Government Statistics. John Williams, not the movie composer, I assume. Must be a pretty common name, I suppose, right? This graph is very interesting. All he's doing here is he's taking the CPI number and he's calculating it as they did in 1980. You see, because a lot of people don't realize that over the years, especially starting in 1980, they made a lot of changes to the ways they calculated the CPI, the inflation. And coincidentally, those changes always seemed to make the CPI that they ended up getting, it always ended up making the CPI go lower. So as we know, the Federal Reserve is a body that is supposed to be independent, that on paper is independent. But never forget that the Federal Reserve Chairman is appointed by the President and confirmed by the Senate. In other words, he's not fucking independent. The Federal Reserve is not, and he is the highest member of the Federal Reserve, and I don't know the extent of his powers, but he is the chairman, and he is appointed and confirmed directly by the politicians. So he's not fucking independent. He works for the politicians. So it would be in their best interest to make the CPI seem lower than it actually is if they can. Because as we saw in the late 1970s and early 1980s, politicians tend to lose their jobs a lot quicker when inflation is high. Nothing pisses off an electorate more than high inflation or other economic issues like very high unemployment. You had the highest turnaround rates you know, in Congress, in the Senate, of the 20th century, at least since the Great Depression. I pulled up a graph on an earlier video. Now here we can see the orange line is the CPI as released by the government, the official CPI. You can see right now, according to the official CPI, we're at 7%. The blue line is the CPI as of 1980. And you can see that it starts to diverge 1981. It starts to diverge by 1986. You can see a clear divergence. By 1991, the divergence is even bigger. And then look, they just keep changing the rules. They keep doing rules changes all throughout this period. And you can see the 1980s based CPI diverge more and more from the actual CPI. So according to this chart, we've been around 10%, really between 8% and 10% for the past 10 years. And you can see that right now, according to this calculation, and as far as I know, this checks out. All he's doing is taking publicly available information, the CPI calculations from 1980, and the current CPI data. He's putting that, combining those two to come up with this number. And I haven't seen any rebuttals to this yet. People that don't like the numbers just seem to ignore it because they have no counter argument to this. It's very simple. He's just taking the official CPI number, and which, if you look at the CPI release, the official release, it has all of the numbers laid out there. It goes into pretty deep detail. He's taking those numbers and he's using the 1980 methodology. So according to that, we're at 15% right now. But forget about the number. According to that, we are at the same level of inflation as supposedly the worst inflation in history in 1980 and 1981. So our inflation is as bad as it was in 1980 and 81 when the inflation was the highest inflation in history, at least in the 20th century. It may have, I don't know, maybe since the Great Depression at least, and since, the 20s. But as far as I know, that's the highest inflation in history, at least since they kept, they probably didn't start collecting inflation data until the 1930s. That's when most of the economic data started to get collected. So we're at 1980 level inflation. And so the Fed says, well, let's go to this. Daniel DiMartino Booth says it best. The Fed's biggest challenge is figuring out how to implement policy measures that are hawkish enough to lower inflation but also keep financial markets afloat. The Fed is faced with choosing the lesser of two evils. That may be what the Fed is faced with from her perspective, but I think what the Fed believes is that they can do two things at once. I mean, they've used language in recent months. We're going for a soft landing. I think they used that soft landing terminology. Everything they say is very calculated. Every word they use, especially in their press releases, is very carefully chosen. They said soft landing. We're going to go for a soft landing from inflation. So what that means is they intend to thread the needle between controlling inflation and not destroying the markets and not destroying the economy. Now, as we know, in the 1980s, Paul Volcker raised the Fed funds rates to 20% in 1981. 20% is what it took to get the inflation of 1981 down, or start getting it down. We're at the same level of inflation that we were in 1981. So it would follow, it would make sense that we would also need to go very high to the teens and 20% possibly to get this inflation under control. No one right now, if you tell any, there's no way that the Fed could raise rates to 20% anytime in the near future. No way. The Fed just wants to raise rates to 1% by the end of the year, at the most. What is 1% going to do? If you have a 1% interest rate, even using the normal, our official CPI numbers, that would put us at a negative 6% real interest rate. No one's going to save money and stop wasting money and spending money when you have negative 6% interest rates, real interest rates. See, the point of raising interest rates is to get people to spend less, to save more. They have no incentive to save with negative interest rates, negative real interest rates. If we take obviously the 1980 CPI calculation into account of today, you're talking negative 14 real interest rate, negative 14 real yield. So what's 1% going to do? And if we go to 2% next year, what's that going to do? You see, they're pussyfooting around, trying to do two things at once, trying to please everybody. You know, rubes and normies are going to think they look decisive. Wow, look at them. They're raising interest rates to 1%. The government's going to come and save us. %1 is going to do nothing. It will disrupt the stock market. And it will cause a lot of problems. You see, because we've had interest rates so low for so long, corporate debt today is getting close to 12 trillion. It's at like 11.4 trillion. There is $11.4 trillion of debt outstanding in our nation's corporate sector. Raising interest rates, obviously the economy of the United States is dependent upon debt, and that's because the government encouraged it by keeping interest rates for so low for so long. By doing the quantitative easing and keeping the Fed funds rate low, it basically forced companies, if they wanted to stay competitive, to borrow money. In a normal environment, they wouldn't have even have borrowed money. The government put us in this position. That's important to recognize. Because they already started a few weeks ago, I think. A bunch of companies got pissed off because Biden said the private sector is causing the inflation. As the situation gets worse and worse, they are going to blame the private sector more. But make no mistake, this problem is caused by bad government monetary and fiscal policy. They're forcing companies to go into this massive debt. And if you raise interest rates when you have 11 $11.5 trillion of corporate debt in the system. That's a lot of money. $11 trillion is a lot of money. That's going to have a severe disruptive effect on the economy. You have this. I remember that this report came out in 2020. According to Deutsche Bank, almost 20% of U.S. companies were, quote, zombie companies. So a zombie company are firms whose debt servicing costs are higher than their profits but are kept alive by relentless borrowing. Their interest payments are more than the profits that they make, but they just borrow more money to keep the company going. You start raising interest rates, you're going to see a lot of these companies go belly up really quick. According to the Fed, even the Fed admits, and you know, the Fed is not in the business of telling the truth. They are a political organization. They work for politicians. They are basically an arm of the government. They have a mandate. Their mandate is to help keep politicians from losing their job. That's their real mandate. That's proven by what they did with the CPI. They changed the CPI starting in 1980 to make it look like it was a lot less, to keep the politicians in a better position. Even the Fed admits that there are 9% of U.S. companies are zombie companies. So raising interest rates, first of all, by quantitative tightening, that increases the rates on the secondary market. It makes debt a lot higher. You know, debt becomes a lot more expensive. And then increasing the Fed funds rate, which is basically the rate at which the large banks borrow from the Fed, that trickles down into the rest of the economy. You're going to see some companies go belly up really quick, and a lot. That's going to raise unemployment. That's going to fuck up the stock market. If the stock market isn't as profitable, it's not that the stock market even needs to crash. Even if the stock market goes down slowly or goes mostly sideways, that's going to cause serious problems in the economy. A lot of people have been living off of this bull market that we had the last couple of years. If they're not able to make so much money day trading anymore, they're going to start filing for unemployment, or they're going to start looking for a job. I guess they can't file for unemployment if they were self-employed. I don't know how that works. But they're going to start looking for a job. Unemployment rises. At the same time, inflation is going to keep at the same levels, if not go a bit higher or a bit lower. You're going to see it maybe go up a little bit here, go down a little bit there. I don't think it's going to go down significantly. I think the most it can go down is going to be 4% on the official number, which is more like 10% on the 1980 number. You're going to see people coming back out of retirement and working because they're not going to have enough money. Then their 401ks are going to take a nosedive at the same time that their cost of living is going up. Their 401ks are going to be going down because the stock market's going to tank. So what the Fed is going to do is they're going to try and do two things at once, and they're going to not be successful at either. Okay? They're going to try and lie about CPI. They just changed something about the CPI calculation last month, I think, or this month. Something about using 2019 numbers. Let me see what that's about, if we could find anything. Let me see if I go to news. There's something, I don't know if I'll be able to find it. There was something about them making a relatively minor change, something about using 2019 numbers or something. But you can bet your bottom dollar that any change they make to the calculation is going to move the CPI in one direction, which is down. So you might see it decrease a little bit. And I think they're going to go for more and more shenanigans, but I don't think it's going to work like it worked in the 70s or in the 80s. I think people are. I think what I feel, the pulse that I'm feeling, is that people are starting to. I don't want to say wake up, but people are starting to get more and more skeptical of the government at this point. As I've said time and time again, the government, the federal government, is losing legitimacy and losing it fast. It's going through the process that every empire regime has gone through in history, which is they get too big, they get too corrupt. The bureaucracies that were initially formed to help administer the empire efficiently become parasitic, okay, and counterproductive, and end up bringing the empire's downfall. We are headed in that direction. So they may try and lie about CPI, but I don't think it's going to get them that far. But they're actually doing themselves a disservice. Perhaps if they just would have let inflation go crazy, but as long as the stock market's doing good, I don't know. They're in an intractable situation, but what they're doing is they're being indecisive. They're trying to do two things at once, and it's going to end up being a worse. I don't know if you could say a worse disaster, because either which way, it's going to be a disaster. But what we're going to end up with is high inflation and a bad stock market, which right now, or up until now, all we've had is high inflation. Okay, the path they're going, they're going to have high inflation and a bad stock market. They do have to do something about inflation, but they are not willing to do enough to actually fix the problem. So it's going to be interesting. I would expect if they can't even follow through with the 1% increase in rates, then it's game over. I mean, it's going to be game over quick. But if they do follow through with it, it'll be game over eventually anyway. It might buy them a little time. That's all they really want to do at the end of the day is kick the can down the road. I mean, that's their whole modus operandi, or whatever you call it, is how can we kick the can down the road a little bit longer? I think the federal government's falling apart. I think that it's going to hit a monetary and fiscal crisis it won't be able to get out of. And the states are going to go and start doing their own things. I don't think the federal government's going to disappear entirely, but it just won't be relevant. But yeah, so that's my prediction. And as far as the supply, I have to bring this up. I always forget to bring this up. The supply crisis. Of course, they're going to attribute the inflation to the supply shortage. Riddle me this. How is it that we have a supply shortage when we have every month we break the record for trade deficit? Every month is a new record for trade deficits. We had over $100 billion in December of a trade deficit. $100 billion. We had over $1 trillion trade deficit last year, which is by far the highest in the world. So how do we have a supply shortage when we have the highest trade deficit in history? How does that work? I don't get it. Someone do the math for me there. Do we have, is the population, I mean, is it that I don't know. I just don't know. I mean, sure, there might be supply shortages of certain items in certain locations, etc., especially in shitty blue states that are falling apart because the people over there are stupid. So they're falling apart. They have empty shelves. Washington, D.C. has empty shelves. They fucking deserve it. But as far as the supply shortage being the primary cause of inflation, I don't buy it. Obviously, the real cause of inflation has been the loose monetary policy, which has brought demand up to astronomical levels. You have the M2 going off the charts, the M2 money supply, and perhaps fewer goods and services being produced to some extent. But they're using this supply shortage as an excuse. It's not. It's not the supply shortage. There's much more to it. So what their line is right now is, oh, just wait. The supply shortage will go away and then inflation will go away. Like I said, it might go down a little bit. Right now it's at 7%. I can see it going at 4 or 5%. I see 4% being the absolute support level, the absolute floor for inflation for the near future. And raising interest rates to 1% is not going to do anything other than disrupt the economy, because our economy is very fragile, very dependent on debt, very overloaded with debt. So that's what I think. You're going to have a rocky stock market, maybe a crash in March when they do the first rate cut, March or April. We'll see what happens. We'll see if the Fed gets cold feet and stops raising interest rates, or if they start buying assets again. It is true that more people are affected by inflation than a crash in the stock market. That is true. But the people who rely on the stock market have more power than the people who are severely affected by inflation. That's it. It's going to be interesting. I have nothing else to add, so I'm out.